A trader comes in, he uses 10 times or 20 times the leverage since the broker has given him. What happens is in just 2 or 3 trades he burns up his account. Imagine if he would have not used his leverage. Maybe after the 3 trades, he would have made all the 7 trades as profitable trades. Imagine you wish to enter a trade at 100 rupees and the market is now at 110. Now if the market comes down to 105 or 104, we would now heed to our emotions. Automatically we get some kind of an emotion. If we ask most of the traders, they'll not have a reason for entering a trade. They'll just say, when I saw the laptop, the market was at the top and I went for a short, or the market was at the bottom and I went for a buy. So one of the category of traders, they look at the numbers and colors of a candlestick. So that is one of the biggest problems. Hi there guys, welcome back. This is Kishore, founder and CEO of Trade Achievers. So in today's topic, we are going to talk about the 5 most common trading mistakes a retail trader makes. So the first topic is the lack of trading plan. So the first mistake a retail trader makes is the lack of a trading plan. Now it's not necessary for a trader to have a trading plan. But you know what is the mistake a trader makes is most of the retail trader trade without a plan. That is the problem with the people. See, if we ask most of the traders, they'll not have a reason for entering a trade. They'll just say, when I saw the laptop, the market was at the top and I went for a short, or the market was at the bottom and I went for a buy. So one of the category of traders, they look at the numbers and colors of a candlestick. So that is one of the biggest problems. So for them, 3 green candles means it's a buy, or 3 green candle, if it forms a 3 red candle, it means sell. So they are wrong on approaching to trading. So most people never have a trading plan. They don't have a solid reason to enter a trade. So what happens is they don't think about their trading setup before entering a trade, but many grumble after entering a trade. So for first mistake which a trader has to avoid is the lack of trading plan. All right, and the next problem with the trader is they lack practice. So the second most common mistake a trader makes is the lack of practice. So most traders will not have a proper knowledge about technical analysis. So they just depend upon some kind of indicators to trade in the market without proper practice. They just want to go with an indicator or some kind of a signal service. So that is the biggest problem. So some practice some strategies without proper understanding of the strategies. They don't know whether they are approaching it correct or not. So one more thing most of the people do is they go for paper trading. Say practice means to execute the trade in a live market and follow up the results. Now paper trading will not make a good practice for the financial markets. So my sound advice to the trader is not to do paper trading, because remember, doing paper trading is similar to cheating ourselves. That is what we do. So I'll tell you an example from our office itself. Here we had a team. They were into paper trading. I used to interact with them, and what happened is they would tell me they made 10,000 profit today and 20,000 profit in paper trading. Then what happened is they invested real money in the markets. After investing real money, they started making losses of 10,000 and 20,000 per day. Now what I said is, what is going to happen? So what happened is they just went back to the paper trading to practice again. And what happened is once they went back to the paper trading, they started again making profits of 10,000 and 20,000. So this is what happens when you are doing in paper trading, because see, what people does is when for an instance, even when the trade is not executed at their price, they just imagine, okay, I have this is the price I had to buy and the market has come near that and I'll write it down, so I have already entered the trade. So see, it's not going to make of any use. And what happens is, if market, for example, let's say if the market has to hit the target at 100, if the market goes to 98, In the live markets, they'll not be closing it. They'll be waiting for the 100. But in paper trading, if the market goes to 98 and comes back to 90, what they do is they just say, okay, I have finished all the trades at 98. So that is why they are making profits in paper trading. And when it comes to live markets, emotion starts to play and they lose money. So this will never help us to get a complete structure of the trade and help us to understand the market. So try to avoid paper trading. So this is the second common most mistake a trader does in the financial markets. And now coming to the third one, FOMO. So we'll just discuss what is FOMO. FOMO. That means fear of missing out. It's a human psychology to be eager and to be eager about anything they come across. Imagine two people talking with each other, and it's a human nature to pay attention to what they speak. The same mistake happens in trading as well. Imagine you wish to enter a trade at 100 rupees and the market is now at 110. Now if the market comes down to 105 or 104, we will now heed to our emotions. Automatically we get some kind of an emotion. It's like FOMO. Without waiting for the price to come to that range, we will enter into the trade at 104. Now if we were to keep our stops at 98 and stop gets hit, we would lose around 6 points in the place where if we would have taken the trade at 100, our stop would be just 2 rupees. Now why this happens is, this happens because of lack of patience. See, one thing keep in mind. Patience always comes with knowledge. See, only when you have certain knowledge about certain something, then you get patience. See, we have a proper reason. We need to have a proper reason to enter into a trade. We also have practice, but where we lose is with the lack of patience. Don't let your panic modify your trading setups, or let your emotions modify your trading setups. Imagine two people are traveling to a particular place. One has a knowledge about where he is going to go and the other doesn't know. The one who has the knowledge will be patient enough, as he would know how many kilometers he has to travel and how many hours of time it will take. But the other person who doesn't have a knowledge about it will become tensed and will be panicking, as he would not be having a certain knowledge about it. So that is because when you don't have certain knowledge about something, you lack patience. So emotion is an important place in financial markets. All right, and the fourth one, what we are going to talk about is FOLM. So the first emotion what we talked about is FOMO, that is fear of missing out. And the next one what we are talking about is FOLM, that means fear of losing money. See, while the first caused the trader to enter earlier than the actual entry points, this FOLM causes the trader to cancel the trade as the price approaches the entry. See, when the market comes to an entry price, they because of fear of losing money, will begin to think whether our stops will be hit or whether we would lose money. So now one thing which we have to understand is that nobody should expect all their trade to be successful. If we start to expect like that, it is not possible for us to trade, because through technical analysis, what we do is we analyze the script based upon facts and the history. Now these predictions need not be correct all the times. Even for a professional trader, what happens is they are only 7 to 8 times successful in a trade out of 10. So in order to make money, we have to be willing to take some risk. To make money, we have to take certain risks. This is not the case of financial markets alone, but be it any kind of a business, risk is just a part of the game. So instead of sitting on the sidelines, we should make proper risk management plans first of all. And I would suggest, if the trade offers a risk to reward of 1:2, we should be aware of that. With a risk to reward 1:2 or 1:1.5, 50% of the successful trade means you are in profits. So fear of losing money is another emotion which plays a major part in the financial markets. And the fifth one what we are going to talk about is use of high leverage. So normally what happens is Indian brokers usually gives 10 times leverage to trade. It is known as exposures among the retail traders. Now, what a retail trader usually thinks is that the leverage will increase profitability by earning 5,000 instead of just 500. What most people fail to understand is that they also come with increased losses. See, if you're going to make 500 instead of 500, if you're going to make 5,000 as profit, same wise, if you're going to lose 500, you can lose 5,000. That is the truth of it. Now, for a trader to know and understand whether he can be successful or whether he is fit for trading or not, at least he has to do minimum 10 trades. See, what happens is, with increased use of leverage, he might burn out his trading account with just 2 trades. Now, if the trader has a proper understanding about the proper risk management and money management, he would have given himself a better chance. See, we have to use leverages to the minimal extent and in trades in which we are confident, so we may have better chance. So I'll give you an example. For example, it takes minimum 10 trades to prove whether you're a trader or not. Say a trader comes in, he uses 10 times or 20 times the leverage since the broker has given him. What happens is, in just 2 or 3 trades, he burns up his account. Imagine if he would have not used his leverage. Maybe after the 3 trades, he would have made all the 7 trades as profitable trades. We would not know that. So even the trader is not giving himself a chance to prove whether he is fit for trading or not. So my advice is, don't use leverage. Whatever the money you have, you just try to take trades with your money. In case you are very confident on a particular trade and you know better that this trade will be profitable, that time have a proper stop loss, and that time you can just go a little board and use some leverages. That will be fine. So these are the 5 most common mistakes a retail trader makes when they come into the financial markets. So my advice to you is, avoid these mistakes, have patience in the market, learn proper technical analysis and fundamentals, and try to practice the strategies which you have regularly so it becomes a profitable trader. So this is what we teach in Trade Achievers. We help people to understand what is the financial markets, as well as we teach more than 14 subjects of technical analysis, starting from trend analysis, support and resistance, and we have supply and demand zones, where to place our stop loss, and Fibonacci, where to take an entry and where to go for an exit. So these are the combination of subjects we teach to the people on how to take a trade with proper facts. So in case if you want to learn all those stuffs, you just have the number on the screen, just give them a call and they'll give you all the details on how to become a profitable trader. So I hope this video was helpful. Thank you very much for joining. Take care.